Hey there, it's your financial maven. I am coming to you today, just me, no interview, no guest spots today. I'm coming to you because as a CPA for the last 23 years and being in the accounting world for 30 years, I think it's important that I take some time to go over the new One Big Beautiful Bill Act, or OBBBA, which is what I will be calling it throughout the podcast, to give you guys some insight and information. Since the law was passed and signed on July 4th of 2025, I have taken several continuing education classes. The accounting world is really lit up trying to interpret or read exactly what the bill is saying and kind of looking for those areas that may need to be updated through technical changes, or maybe new legislation needs to be passed, and also the interpretation of the IRS, which is part of the Department of Treasury. So I think it's really, really important. I have my notes off here to the side, so you'll see me looking over there just to make sure, because this is brand new. I am learning like you are learning. This tax season is definitely, we're 6 months away from it. Starts in January of 2026. But this tax season will definitely have its challenges, not like they don't in the past, but this one will have challenges. Like I said, I am calling it the OBBBA. OBBBA. Sorry, it's a lot, right? It's a mouthful. I will not mostly, or I should say, be really going into anything political with relation to this bill. Sorry, I am fixing my headphone. With relation to this bill, I will mention some things. I will be very honest that while this bill does do some good things with regards to making certain tax law changes permanent or still going on from the prior tax act that we had in 2017, I don't necessarily agree with the bill overall. That is my opinion. I don't necessarily see how this bill is going to benefit and help the everyday American. I think in the long run, it's actually going to hurt us, mostly because they have to cut other programming or other federal things in order to fund this. So I personally do not agree necessarily with the overall handling of this bill, what they're utilizing to make this bill work, increasing our debt that we have. I'm here to give you the facts. And if this offends you that I've put a little political tone or I've told you where I stand, then maybe I'm not for you. And to be honest, you know what? I don't necessarily care if this is for you or not in that regards. I am expressing where I'm coming from, and but I'm still going to unbiasedly give you the facts based off of the bill, and I will give you all the resources, all the documents, send you all the links. IRS has set up a great little guide regarding it, but there still is a lot of things that have to be ironed out and clarified. So I am going to give you the facts as it states written down in the bill. I'm going to go over some overall things on the individual side. I will hold off on the business side and do that as another podcast. I just think there's so much on the individual side. For tax planning, I think there's tax planning for businesses as well, but I think the breadth of this bill really deals with the individual tax side, in my view. I will give you what I have currently as it stands right now. I am recording this July 19th, 2025. Things could potentially change in the next couple of weeks. As things get changed and I get updated, I will be coming and updating you as well, hopefully when there's more clarification on things. So I'm going to get started. Like I said, these are the facts. Here's the other thing. If you have your own CPA, tax professional, enrolled agent, and you have further questions, you need to go to them. This is for educational and informational purposes only. I am not doing this based off of specific individual taxpayer or small business client interactions. So I highly recommend, if you want to reach out to me and you have any further questions, feel free. Visit me at www.yourfinancialmavenpodcast.com. click on the I want to hear from you section and leave me your questions and your insights related to this bill. And if I get a decent amount of interaction, I'm going to go ahead and do another podcast on answering those questions through the podcast. And I may get back to you as well via email. But like I said, I won't be doing it on your specific tax situation, just overall in general. So let's get started. I'm going to go over a few things that this provision has extended or made permanent. When I say made permanent, as of the law right now, these changes are permanent, but they can be updated and amended and changed based off of new tax laws, based off of technical changes, depending on how the Congress decides they want to approach or continue to address these things. So right now, as it stands, some of these things are considered permanent. Some of the changes, some of the updates are actually temporary. And again, unless there's new tax laws or changes to those temporary items, they will then expire when their expiration date comes up. So it's very important that you're aware of that. All right, so I'm going to start with very simple. I'm going to do a little history. In 2017, we had a new tax law, the TCJA tax law, go into effect. One of the things that did is it reduced the tax rates through 2025. So in 2025, from 2018, so the law went into effect in 2018 to 2025, your tax rates were 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Now, those are the tax rates. Now, you have to remember that the threshold amounts, the income levels that are affected by those tax rates get adjusted for inflation every year. The IRS comes out with those inflationary rates. The 2025 inflationary rates as of today are set. That doesn't mean that they might not change them before tax season starts in January of 2026, but there is the bracket. I'll leave you links to the 2025 bracket. But what does that mean? So I don't have the bracket up right in front of me, so I'm just going to use this as an example. This isn't actually the amount, but let's say the bracket says you are around $115,000 in adjusted gross income. So you are probably going to be around the 22% tax bracket. Now, like I said, I don't have the brackets up in front of me. This is just an example of what I'm trying to explain to you. So let's just say you're at 115,000 and that fell within the 22% tax bracket for 2024. If it was adjusted, and let's say they adjusted it and now they're saying that for 2025, your income of 115,000 now falls in the 24% tax bracket. So what that means is you really have to pay attention to where your adjusted gross income will fall. You can look at your 2024 tax return, look at your adjusted gross income, modified adjusted gross income after like deductions and stuff like that to see what the tax rate will be, which is what gets taxed against the taxable income. So you have to be paying attention to that. And the reason why I'm spending time on this is because in this new law, the OBBBA, they have made these tax rates permanent starting in 2026, which means they were to expire in 25. They're going to continue that. So you're still going to have those tax brackets, but the income levels, the threshold amounts will continue to change based off of inflation. The IRS usually comes out late fall with those adjustments for 2026. So again, this is part of tax planning, part of it to be aware of. One of the things that the TCJA in 2017 took away was personal exemptions. You used to on your W-4, if you're a wage earner who gets a paycheck and gets a W-2 at the end of the year, would put how many exemptions, and then those exemptions you would get some deduction on your return. Well, those were taken away in 2017 and have now been made permanent. So there are no more personal exemptions. Very important to be aware of that. There was an increase for the child tax credit. It is staying at $2,000 per child for 2025. But they made a permanent extension and it will increase to $2,200 per child starting in 2026. So you're not going to see the change in the child tax credit until you file your 2026 tax returns. So that is something to be important, to be aware of. The next important thing to be aware of is when the 2017 tax law went into effect, it made standard deductions higher. So it made them the increase, right? They increased these standard deductions. They were to expire in 25 and go back to what the standard deduction used to be. Prior to the Tax Act of 2017, your standard deductions were anywhere from $3,000 to $6,000, depending on how you filed. Single, married filing separate, head of household, married filings separately. When they increased them initially, and they ranged anywhere from $12,000 to $24,000 initially, again, based off of your tax status. So now they have made those standard deductions permanent. And for 2025, your standard deductions would be $15,750 for single, $31,500 for married filing jointly, and $23,625 for head of household. And I believe for married filing separate, you would get a bit of a standard deduction, but not the full $31,500. Well, what does that mean? Well, if you like to itemize, which is, your mortgage interest, your real estate taxes you paid, your charitable contributions, medical above a certain floor, you would have to, if you are filing single, have to have itemized deductions above $15,750. And I have come across majority of taxpayers that I've worked on over the last 5 years have taken the standard deduction. They just did not have enough itemized deductions. That's not necessarily a bad thing. It's just something to be aware of. Those amounts do get adjusted annually for inflation. IRS will come out with those sometime probably late fall, like I mentioned before. So just to be aware of, these have been made permanent in that regards. So you have to be aware of that. The other thing with regards to itemized deductions, which a lot of my clients weren't aware of probably until around 2023, 2024, again, just the knowledge of it, is the prior Tax Act of 2017 took away or temporarily suspended miscellaneous itemized deductions, things like on the federal level, right? We're talking about things on the federal level. Your state level may not have made changes. So remember, you have to be aware of that as well. Things like union dues and investment fees, other itemized expenses that reach a certain floor were temporarily suspended. The only thing that was not temporarily suspended in those years was the educator expenses, which is really a deduction, not an itemized item. Now, they've permanently suspended those miscellaneous itemized deductions, except for the educator expenses. So what does that mean? If you're paying union dues, you can't take that on your federal return, but you most likely can take it on your state return and local where applicable. You need to find that out. I know in the state of Pennsylvania, union dues are still allowed to be deducted on the state return, but at the federal level, they're not allowing that. That has become permanent, and it does start in 26, meaning it would have expired in 2025 and become, you could take them again, and now they've extended it and saying you no longer can take those. There are some other things with regards to individual taxes that have been updated. I'm not going to go into them here, but I am going to leave a link to a chart that was provided by the American Institute of Certified Public Accountants that gives you a little bit of a summary of kind of what those other changes are. But I am going to go and take some time for 3 areas that I think a lot of people are talking about. I see it a lot on the internet. Even the federal government is sending out information that is misinforming taxpayers, in my opinion. I received a Social Security Administration email, and the information in it was disinformation. They were not explaining it in the detail that the bill does. And while they were probably wanting you to click on it and then you read it, that initial email, a lot of people just read the initial email and go off of that. They don't necessarily do their research, which I highly recommend. You always have to do your research. That it is only for particular taxpayers and there are limits. So I'm going to go through all 3, which is the Social Security, tips, and overtime, to explain that. There are a few other key provisions that came into play that I'm not going to go over, but I will leave information in the show notes, links to my website that have that information. I'm going to start with Social Security because I think that is so important. In the tax bill, nowhere does it state that there is no tax on Social Security. That is a misnomer. That is disinformation. As it stands right now, your Social Security income may still be taxed. So you have to understand that. Your Social Security income may still be taxed. Now, what there is in play, and it starts in 2025 tax year and only goes to 2028. So it is a 3-year temporary $6,000 deduction for those that are 65 and over only. And I say may get the deduction. So what that means is you have your Social Security income, you receive the 1099 SSA form that the federal government sends you. It shows you your Social Security income, if you've had any Medicare benefits, and also any tax withheld from that Social Security income. That has to still be reported on your tax return, and it may be taxable. So the income still has to show. Well, what is this $6,000? It is an extra deduction for those that are 65 and over, in addition to either your standard or itemized deduction. So it doesn't matter if you take the standard deduction or the itemized deduction. It is an additional $6,000. Now, here's the thing. That $6,000 could be reduced, right? There are income thresholds. There are phase outs. So if you are over $150,000 for married filing jointly, or $75,000 for single or head of household, it will potentially reduce that $6,000 deduction or exemption, however you want to call it. If you file separately, married couple filing separate, you don't get this at all. So again, tax planning. If you are filing married filing separate and you are over 65 years of age, you don't get this deduction off of the tax return. The other thing is that they state is it will get adjusted over the years. They're part of that IRS inflation adjustment. Again, I'm going to stress it's only from 2025 to 2028. And if you are filing jointly and one spouse is 65 and one spouse is not, the one who is 65 may be able to get the deduction. It doesn't work for the person who is under 65. Because here's what I tell all my clients. When you file a joint return, the IRS still considers you individual taxpayers. You're just combining your stuff. And it's really important to understand that when it comes to things like this. And like I said, the married filing separate cannot do it. The other thing, which is what they've done for the Social Security, the tax on tips issue, and the overtime, is you have to have a valid Social Security number. That's it. You have to have a Social Security number. There are individual taxpayers who pay their taxes, or let's say even for children who are there for deductions and may have to file their own tax returns, that have an individual taxpayer identification number. It is there until they can get their Social Security number. You can't use that to get these deductions. That's just how it is. So that's where the Social Security is. And it's really important to remember that there is still tax on Social Security. What this deduction does for those that are 65 and over is potentially reduce whatever tax may be on reportable Social Security income. And I have to stress that because it's really important, especially in these 3 areas. The next one I'm going to go over is the no tax on overtime. And the reason why I put it in quotes is you do not get a reduction in the taxes you paid on overtime income you are receiving. Well, what does that mean? You're working, you pay overtime, you're still paying taxes on that. What this also is a deduction at tax time when you go to file your return. Very important to know that. Now, this no tax on overtime goes from 2025 to 2028. Again, it is temporary, and that it is a deduction on page 1 of your 1040, or it might be page 2. The first 2 pages of the 1040 have gotten a little long, so it goes on your 1040 return. It is capped at $12,500 for single and $25,000 for married filing jointly. And like I said, married filing separate does not get this benefit. It is the premium portion of overtime on qualified overtime compensation. Now, The IRS needs to clarify that a little bit more as to what is considered qualified overtime compensation. There is a formula, there is more clarification, but that is what it is stating, and that there is a phase out. So if you are filing jointly and you have income of $300,000 or more, it gets phased out, this cap. Like I said, $12,500 for single, $25,000 for married filing jointly. The phase out starts for all other taxpayer statuses at $150,000, excluding married filing separate. And then, of course, starting in 2026, it will move, with inflation. The other thing you have to be aware of is this no tax on overtime, from an employer standpoint, having to track this and having to report it separately on the W-2. Now, your W-2s, I believe, for 2025 won't have the change on it. So payroll companies, employers may have to put that information in box 14 if you're a wage earner who gets a W-2 at the end of the year. If you are self-employed, and there is overtime, there are some regulations, I believe, on that. There needs to be clarification on that as well. But basically, this has to be tracked separately for employers. What I'm hearing is from this point going forward, you should be tracking it separately, but you need to estimate or go back and figure out what the first half of the year's overtime that might qualify for this so that you can give this to your employee. So there are going to be some changes in regards to that. But like I said, there could be some clarifications, more adjustments on the no tax on overtime. And like I said, it only goes 2025 to 2028. Last one, the no tax on tips. Again, I put it in quotes because just like Social Security and just like the overtime, there is nothing in the bill that says we're not taxing your tip income. You still have to report your taxable income on your tips. Your tip income still needs to be reported. That just is what it is, especially if you want to take the deduction. You need to still report your tax tip income, which means all your income that you report on your tax return still gets calculated for taxes. So there isn't a fact that you get your tips and they're taking no tax out. You still have to report that income. So I spent a lot of time. I sent an email out to my clients on this area as well because there was a lot of information. And so what the OBBBA says is it allows employees and self-employed individuals in a tip-based occupation, which still needs to be defined by the IRS, the Treasury Department. There still needs to be clarification as to what are considered qualified tip-based occupations, to deduct qualified tips from taxable income. So what you need to know is qualified tips, as being defined right now, is considered voluntary cash or charge tips received directly from the customers. So if a customer pays you in cash, via credit card, via Venmo, like a third party, it is potentially a qualified tip for this deduction. Again, these things really need to be ironed out, but that is what it states in the law. There are limits to this deduction. The maximum annual deduction for tip income is $25,000. Now, it states for self-employed individuals, the deduction cannot exceed their net income, excluding this deduction, from the business in which the tips were earned. And again, this is just a high level that needs to be fleshed out a little bit. It is available to taxpayers, whether you itemize or take the standard deduction. And I believe that's the same thing for the overtime as well. What they did with a lot of these things is say, if you're itemizing or taking standard deduction, these extra exemptions deductions may be allowed. So that is very important to be aware of. What they do say is, so there is a group of individuals like myself, a CPA, accounting firms, law firms, I think some in the medical profession, they call them specified service trade or businesses as defined under Section 199A are not eligible for this deduction. What does that mean? If you have employees that work for you in one of these types of businesses, your employees are not eligible at this point for this tax on tip deduction. So it's very important. Now, it has been defined by the IRS. I can leave a link as to what they're defining right now as SSTBs is what they call them. That could be changed in technical writings. That could be updated, things like that. There's also phase out of who can take it, and similar to overtime, $150,000 for single filers, $300,000 for married filing jointly. And again, married filing separate, I believe, is not allowed for this deduction either. So it's very important. And also regarding employers on this and how they have to report it. So employers have to file informational returns, whatever that might be, showing these tax on or the tip income. And they have to include the amount of the tip received and the occupation of the tip that the recipient is, because there is qualified occupations that can allow for this deduction to occur. Again, talking about transparency, there is some guidance and transition relief for employers to be able to do this for employees. And there was explanations related to small business owners as well. For employees, it is important to note that workers in eligible occupations can claim this deduction for qualified tips, may claim this deduction for qualified tips, reducing their taxable income. You have to ensure the proper reporting of your tips by the employer and that it is qualified. So pointing that out as well. Really, really important to understand these things. These were definitely the big ones. One of the other ones that came out of this, which I didn't really go through to explain to my clients, but I'll talk to you briefly about it now, is deduction for auto loan interest. So we've not been able to, for personal or car loans, have that as being deductible. This new tax law, which goes from 2025 to 2028 as this temporary deduction, can be up to $10,000 for new cars that are purchased between 2025 and 2028 if assembled in the United States. It clearly states that in the law that you buy a new car these next 3 years, it must be assembled in the United States. There are phase out limits. It is not adjusted for inflation, but you potentially could get a deduction for an auto loan interest up to $10,000. So that is something to be aware of. So those are the things that I'm highlighting today with relation to the OBBBA. I hope that you got some great information out of it. Like I said, if you have somebody who prepares your taxes, a CPA, an enrolled agent, other tax professionals, check with them if you have specific questions. If they're preparing your returns and you have tax planning questions, check with them. If you have other general questions or you need more information as to what I gave you, like I said, feel free to reach out at www.yourfinancialmavenpodcast.com. Click on the I want to hear from you section and let me know your comments and questions. I will be doing another recording in a few days for businesses. I want to go through those parts of the tax law. Like I said, in my show notes, I will leave you all of the links and information you may have. But for now, this is Your Financial Maven. Have a great day, guys. The purpose of this podcast is to provide general information on the subjects discussed. It is for educational, informational, and entertainment purposes only. You should consult your CPA, accountant, or tax professional for all of your specific financial needs or situations. I just love being able to provide financial education empowerment to everybody out there. And I would love for you to be able to support that too. And now you can. Click on the link in the show notes or at my website, www.yourfinancialmavenpodcast.com, and support the podcast. You might even get a shout out on one of our episodes. This episode was hosted, produced, and edited by Samantha M. Besnoff, CPA, and Your Financial Maven, LLC. Music was written, composed, and performed by my cousin, Dr. Daniel Shore.